how am I going to buy my first house? Because for a lot of people, for example, that grew up in their parents' house, chances are they probably can't buy a house where their parents live. If your work is inner city, if your family is in a certain area, and now you got to go somewhere completely different. Is the traditional rule book still valid?
No, probably not. It's I think the market's changed. And it's interesting because about 10, 15 years ago, the Building Association was educating builders to design houses differently because their kids were staying longer. We're getting to this situation where we've got 2 generations living in a house and sometimes 3. The average first home buyer is 36, up from 27 in the 1990s. And around 30 in the 2000s is the figures I have as well. So the markets have shifted, but the prices are moving up. And so every paycheck, a percentage of that money, 10%, 15%, 20%, is put away into a savings account for my future. And by doing that, you're creating wealth automatically. When you're young and people are young and living at home, their cost base is very low. Mm-hmm. And when it's very low, they can actually save. I've spoken to some people recently and they go, 20%, we can save 60%. Like I put 10% away, 15%, 20%, or if you're young and still living at home and 50% of your wage goes away, spend the rest and enjoy life.
Let's talk a bit about ways to make money from property. Have you heard about this 50-year loan thing that Trump just announced?
No, I haven't heard of that one yet. But
good
luck.
Yeah, right. So our commentary might be a bit dated by the time this comes out or whatever. But I mean, Trump just announced that you can take now. So traditional mortgages, 30 years. Everybody sort of does it. 50 years, he says. So stretch it out.
Yeah. My initial response is compound interest is going to catch up with you.
Compound interest catches up with you over 30 years.
Correct.
Imagine. So I was getting ChatGPT to do numbers for me on this.
Where are you now?
So apparently, if you look at median house pricing in Melbourne, it's about, I think, 925 odd grand.
Yeah, it's close. Yeah.
And so if you put a 20% down on something like that, you put about, I don't know, 180 or something down.
Yep.
740, 750.
That's the figures I've got.
Yeah, 740 is your loan amount. Say you got about 6%, give or take, as your home loan rate.
Yep.
Over 30 years, the nominal amount that you will pay in terms of interest is about $800,000.
Correct.
That's almost the entire value of the property. It's definitely more than a loan amount.
Correct. Yeah, it's almost doubles over 30 years. Yeah.
Yeah, it's crazy. And it's so interesting. So my baba was telling me that his friend's telling him about buying a house, and he's saying that buying a house with a mortgage is telling the bank, one house for you, one house for the bank.
Yeah, that's one way of looking at it. But you've still got to marry that with the cost of you got to marry that with the cost of renting as well. You've got to take that into equation. So if you're renting, you're potentially paying off someone else's house and not your own.
Potentially.
And I've got quite a few clients that come to me, and I'm working with one at the moment where it's going to be cheaper for them to buy than to continue renting.
Yeah.
Because the rents have gone pretty hard in the last 5 years.
Yeah.
And there's investors stepping out of the market, especially in Victoria, because of land tax. So the rental pool is shrinking.
In Victoria?
In Victoria.
Yeah.
Yeah. And so, but the number of people that are renting is increasing because of the net migration that's coming in.
Yeah.
So we've got those challenges, and I wonder whether we should be tweaking our policies to encourage investors and encourage that, because if you encourage investors, then you'll encourage development and have more houses built.
Yeah.
As opposed to what's happening right now, where I've got clients stepping out of the investment space in Victoria. Yeah.
It's interesting.
It is.
So,
it is.
So we're talking all things property.
Okay. And you mentioned something before that I'd like to come and address, which was the compounding.
Yeah.
And the size of the loans, and an 80% loan on an average purchase in the 900s. And one of the things you can do is use compounding to your advantage. And one of the things I do with my clients is help them understand how to pay off their home loan quicker and save a whole bunch of money. So I show them some examples and some calculations on a $350,000 mortgage, which is not a big mortgage, about half the size of what you were proposing earlier.
Yeah.
And if you paid an extra $100 a month, which is not a lot of money, you'd save nearly 3 years and about $60,000 in interest over that 30 years, right? For $100 a month. So that extra $1,200 a year would save you $2,000 a year over the next 27 years.
How about that?
Right? So that's pretty good. But if you can change that and turn that into $100 a week or $433 a month, you would actually save 10 years off your loan and $160,000 in interest. And that's just for a $350,000 loan.
And so what's that look like in terms of monthly payments, say?
Well, it's an extra $100 a week, so you're adding an extra $433 a month to that.
Yeah, and what would be an estimate monthly payment for a loan like that, 320?
$320, you're probably paying in the order of maybe $2,500 a month.
Yeah.
So you might take that up to $3,000 a month. A lot of the people I talk to go, yeah, I can afford that. And I encourage them to do it especially early before they start maybe having families and having the bigger expenses in life like education and their kids and things like that, because what you do up front has a maximum impact on how it plays out at the back end.
Yeah.
And then there's things like using your redraw or using an offset account for that. And parking any spare money you have that you need to use later, but you park it in the account and then you can, and that's offsetting your interest as well. Because what people don't understand or what they don't know is the bank's calculating your interest daily on your account and they charge it to you monthly. And once you understand this, so whilst we have high levels of debt per household, it's manageable, and the Australian markets and financial markets are geared to that. 60% of all the bank's lending is in mortgages. So by doing that, we're actually, and if you teach people to manage that and pay it down quickly, they're actually putting themselves in a less riskier position. So it's offsetting the fear of having that debt with being in control through education.
Yeah. Okay. Well, let's unpack that a bit. But firstly, David, thank you for doing this.
Thank you for inviting me.
Mate, appreciate it. I think we've known each other probably about 4 or 5 years now.
Yes,
You've been a great long-term client of mine. For those listening, a little bit of context, I suppose. You run your own business, Barker Finance, working with a range of people that want residential loans. You're also in commercial. You also do bespoke financing, and you've been in the industry for about 20, 25 years now.
Yeah, just under 25 years, yeah.
That's amazing. I mean, the Australian market's obviously had an exceptional run when it comes to property.
Yeah.
And I think everybody sort of, views property as this big cornerstone in their portfolio, especially people that are probably not as active in other forms of investment like equities and things like that. So tell me something. Do you think Australia has a property addiction?
I think it is. Is it an addiction or it's a culture? Maybe more, and that culture's come about because of how the government's played it out after World War II in growing Australia and making housing affordable, making finance relatively affordable for the times that were, and allowing people to. I think my parents bought their first block of land for like £1 or something like that, but the rules are you had to build on it. Yep. You had to do something with it, that you couldn't land bank it and things like that. So there were different times, and those generational sort of concepts, passed down from our parents to ourselves, and that's what you do. So I think there's still, home ownership was probably the highest in the 80s, and it's not quite as high as it used to be now. And that's to do with just the growth of the population as well. So do we have a fixation with housing? I think we do. I think all the banking, 60% of the banks lending is in mortgages.
Mm-hmm.
I think the kids now have to, the people now buying houses just have to do it differently to the way our parents did, because the markets do change.
So let's go back in time then.
Yep.
We're post-World War II here. Australia is obviously, it's fairly developed, but way less developed than other parts of the world at the time. And you've got this big wave of immigration that comes in. What's land allocation? How does that happen?
I think it was seen as a necessity in how to house all these people. What happened, post both the First and Second World War is, the soldiers come back and they've, just because of what they've experienced and travelled overseas, you grow when you go overseas and learn what other cultures do. And not all of them went, stayed back in the country and they came to the city. And I think the cities and the councils just decided that releasing land to allow people to build and grow Australia was seen as a necessity because the population was so small compared to the size of the country.
Mm-hmm.
We're as big as America or, big as Europe. So, but with only, we still only have 27 million people now.
Mm-hmm.
So I think the rules and the policies to actually subdivide land were a whole lot more relaxed back then, and we seem to be at the moment. If you look at it now, we seem to be regulating ourselves into slowing down the release of land instead of improving it, and I think that's a concern.
I think this point that you're making around roughly about 60 to 70% of household wealth being tied up in mortgages, I think that's really interesting. The other thing that I find interesting is the average age of a homeowner in Australia now is about, I think, 36 versus 27 in the 90s.
Mm-hmm.
It's a big jump in, about 30 odd years.
Yep.
And I think almost every young person has to ask themselves, how am I going to buy my first house? Because for a lot of people, for example, that grew up here, that grew up in their parents' house, chances are they probably can't buy a house where their parents live.
True.
They definitely can't buy a house anywhere inner city because they're priced out.
Yep.
And so if your work is inner city, if your family is in a certain area and now you got to go somewhere completely different, is the traditional rule book still valid?
No, probably not. It's I think the market's changed, and I think the best thing we can do for our kids is to teach them early to start saving early and putting aside some money. I do that for my kids right now, trying to encourage them to do that. But it was interesting because about 10, 15 years ago, the Building Association was educating builders to design houses differently because their kids were staying longer in the house, right, in the family home. We're getting to this situation where we've got 2 generations living in a house and sometimes 3 as well, and they're redesigning the houses with more en suites. So
it's becoming like India.
Becoming like India, there you go. Trendsetters.
Right, how about that?
But I had the same figures as you. So the first, the average first home buyer is 36 up from 27 in the 1990s and around 30 in the 2000s is the figures I have as well. So, it's interesting how that all sort of works and how the markets have shifted. But the prices are moving up, and I think the only thing that can fix that is government policy. Mm-hmm. Release enough land. It's the economics 101, supply and demand.
Yeah.
If you've got enough supply, then the price will stay reasonable.
Yeah, I don't really have a lot of faith in the government to be releasing land.
No, I don't either. And like the current Labor government, put in the urban growth boundaries, and which basically meant in around Melbourne, for example, and that meant that if you sit outside some arbitrary line, you can't subdivide that land into residential housing.
Yeah.
And I look at that and I go, well, that kind of flies in the face of what you're trying to achieve.
Yeah.
I'm not sure that makes a lot of sense. That there'll be other commentators and economists that will, understand that better than I do. But I look at it and go, I get that you shouldn't go in. Maybe what they should have done is ring fence the areas that they don't want developed and let the rest of it sort of flow.
Yeah, so better land use plans maybe.
Yeah, like sure, there's parks and national parks and state parks and other parks and things and green zones and green wedges and things that you would want to protect, and everything else can be then fair game for subdivision.
So the first theme I suppose I want to tackle, broadly speaking, is property as an investment versus property to live. So if you're advising somebody who's, let's say, in their early 30s, so we've just established that the average home buyer is somewhere in their mid 30s.
Yeah.
Say if you're late 20s, early 30s, you are out of university, you're well into a job, you've started saving up some money. The question of, okay, should I go and buy a house? What do you think? Is it a good investment?
It depends on your perspective and where you're sitting. If you're going purely for wealth creation, to buy a house to live in is considered mathematically and economically not a good outcome. Mm-hmm. That doesn't mean it's wrong, and people like stability, and we've had 80 years of this stability growth, and your parents expecting you to have some stability, and like our partners expecting us to provide stability, if you like, and we expect the same from them. And so I would say it comes down to, a lot of this comes down to people's personalities and what they like investing in.
Yep.
And I've got clients that are what we call rent investors. They're happy to rent and build up a portfolio of investment properties. And I've got others that want that stability and will sink their money into their own home, knowing that then they're not going to be uprooted because the landlord has changed his mind or to own the property, or he wants to sell it, or something like that.
What's rent vesting?
Rent vesting is where the people doing the property investing actually are renters themselves and don't own their own home.
How did that work?
That works pretty simply. I've got a few clients like that. They're happy to just rent, and they see any capital that they put into their own home as not working hard enough. So they'd rather put that capital into investment properties.
Yeah.
And get the returns from investment properties.
Yeah.
And then there's a mix of, if it's not property, it's the share market or equities or something like that as well. So, and it really comes down to people's personalities. I don't tend to tell people which way to go, because it's really down to what their personality tells them they're comfortable doing. And most people love bricks and mortar. They love being able to drive past a house they own or they've invested in and see it. So I even see that with investors. There's a lot of reluctant to invest in locations they can't drive to within an hour.
Yeah.
Right. They just love that. That gives them the level of comfort, and they can see it, and it's tangible, as opposed to investing in the stock market where, I own part of a company, but I can't see it really. I can't touch it, and I don't have, I can't drive past it, if that makes sense.
Well, it depends. You could, but
yeah, you can with some of them, but you still don't. Even though you're the owner, you can't enter it, right?
Yeah.
Sort of thing, if that makes sense. You don't have that insider knowledge.
So set the scene for us. How did you get involved in property?
That's a great question. I was reading a bunch of books in the early 90s and then had a friend who had an investment property, which was a 2-bedroom unit in the Avenue in Windsor. And he said, would I like to buy it off him? And having read some books on investing and understanding that, I said, yeah, I'll do that. And so that was back in 1994.
Good books?
Good books.
Which ones?
Okay, so Jan Summers, Queensland school teacher, wrote 4 initial books she wrote. And she was talking about how to invest, and they're quite educational books. And I was reading a few other books on budgeting and things like that. Noel Whittaker did one called More Money, and things like that. And so I just decided, I had bought a house at that time, but I had decided that, we'll do that investment. And to cut a long story short, I ended up with about 5 investment properties but 2 with granny flats, so 7 rents coming in.
How old are you at this stage?
At that stage, that got to about 2000, 2001, I was 37.
Okay.
And the market's moved. We had, house prices tend to lift every 7 to 9 years, go for a bit of a run, like they just have. And I went through one of those cycles. So, if you're lucky and you hold property for 15 years or 20 years, you'll go through 2 cycles of that and get some good capital growth.
So you were 36 years old at the time. This is early 2000s. We've just done the millennium. How much did you have to put in to buy 5 properties? Like, do you remember how much what your capital outlay was all up?
I don't recall paying. I think I paid lender's mortgage insurance on one of them.
Okay.
But pretty much I'd put in 20%.
Okay.
On everything. I remember come 2001, and I was in the IT industry. I was a PAYG employee. And 9/11 happened, and the whole IT industry stopped, and I ended up unemployed for a period of time, and that happens. And I remember sitting there, and I wasn't stressed because I made sure I had plenty of liquidity behind me, but I at that time had $1.1 million worth of debt.
Right.
Back then.
Yeah.
Across these properties.
Okay.
But I had enough cash behind me to last a while before I jumped back into the workforce, and there were offers coming to do that, so I wasn't worried about getting work. But it's you talk to people like that, and they go, "Hang on, you just got retrenched," and you sit there with $1.1 million worth of debt, and people look at you, and I go, "It's a mindset, and having the knowledge to know what to do and what position you're in, you decide." Knowledge beats fear every time, and you become educated, and that's what I try and teach all my clients.
Yeah.
Because if you know what you're doing and you're prepared for what the curveballs life throws at you, then those curveballs don't matter.
Is that a bad thing?
Not at all.
Is that a smart thing to have in your portfolio?
I think so. Yeah, I think so. Especially if you're into property, then it's a necessity.
Yeah.
You wouldn't want to be totally all capital into property necessarily. You want to leverage a little bit of that, I think.
Let's talk about these 7-year cycles you mentioned. In your experience, how far do they go back?
Probably to the 60s or 70s back then. Every 7 to 9 years, the properties they might go sideways for a period of time, and then they can double in price.
Yeah.
We have had corrections along the way too, the other way.
Yeah.
So in the early 90s, around the location near where I live, property prices were $1 million, and I knew they were inflated, and 1 month later they were 600,000. And that hurt a lot of people.
Yeah.
But it's property doesn't go up in a straight line, but neither do stocks and shares.
Yeah, 100%. I mean, it's interesting, isn't it? Because, now I look at people who have property, let's say, in Perth or Brisbane, and values that have doubled in 3 years.
Yeah.
Versus...
It's had a run.
Yeah, it's had a run. In fact, I think Victoria is the only one that hasn't had a run in the last couple of years.
Yeah.
And so if you're a young person that has no idea about property, that wants to obviously save money, the purpose they think they're saving money for is to buy a house, to get into the system. Maybe, you've just got married, you want to have your first kid. That's a good reason a lot of people buy houses.
Yeah.
What are some of the things that you explain to your clients that are first-time home buyers?
Yeah, it's a great question. So part of what I've do for my clients is I have a training program called Financial Intelligence, and the very first module is to teach people to be prepared for their first home loan. There's no silver bullets. Obviously, I teach people that cash is king. So, in other words, the more savings, when I say cash, I mean money in the bank, but the more savings that you have, the cheaper and easier finance becomes. A lot of lenders offer finance cheaper rates on lower loan-to-value ratios. And so I teach them, and suggest areas where they can get a high interest earning savings account.
Yep.
And be consistent. Consistency is really, really important. So I teach them that. I teach them that credit cards and any other unsecured debts impact their borrowing capacity.
Yeah.
And so prefer, and a lot of people, a lot of the millennials now actually don't have a lot of credit cards. I find them, and just naturally that the others that do have them, I suggest they get rid of them, and they said, yeah, we don't really need them anyway. And they're pretty, I find them pretty disciplined, which is encouraging. And so they're looking for solutions, and they realise that they shouldn't have those debts. And I sort of talk about, how many smashed avocado breakfasts do they have? What are their living expenses, right? Because, and look, everybody loves a smashed avocado breakfast, but
they're getting ridiculous.
It can be, it's quite an expensive pastime.
Mate,
right?
Have you had a cup of coffee at a cafe in inner city Melbourne?
Not recently, no.
I paid $6 for a cup
Did
of
you?
coffee the other day. I said, "This is highway robbery." Well,
I'm going to take you out to a little cafe out east.
Yeah.
Where you can have a big breakfast for about $23, and they've got about half an avocado on it as well.
But that's really interesting. So for people that are thinking about, say, buying a house in the next maybe 1 to 3 years.
Yep.
It's really about starting that preparation early, in a sense.
Correct. So starting that preparation, there's another really good book that I ask people to read, and it's called The Wealthy Barber. So going back to you talking to your barber made me smile. It's written by a guy called David Philipsen. He's a Canadian-based financial planner. He wrote it in about 1990.
Okay.
My wife found that book in a second-hand antiques, whatever store, and bought it for $2 and goes, I thought you might like this, and it's one of the best books I've read that can teach you all aspects of finance, but simple things like budgeting and saving. And the premise in the book is you need to save consistently for your whole life, not just for assets and things that you want, but you should save just because you have a future beyond work. You're going to retire because life will throw a curveball, and we've talked about a couple of curveballs, GFC being one, and there's the two extremes of saving is record everything you spend. And some banking apps now do that, but back in the 90s, there was nothing like that. So to build a spreadsheet and record everything you did, it's a pretty boring existence. And I must admit, I did it for about 12 months, and it really when you do it for 12 months, it's kind of like a study, and you actually learn your spending habits and what you do with your money. But there's a far simpler way for people to achieve that. And that simpler way is to what we call pay yourself first. And it talked about it in this book. But to pay yourself first is to say, I earn X amount of dollars. And so every paycheck, a percentage of that money, 10%, 15%, 20%, is put away into a savings account for my future. And by doing that, you're creating wealth automatically. And this book goes to the extreme of even saying you do that outside of even saving for your house. You keep saving for the future, and even when you've got a house and got home loan repayments, you've still got this saving account going. Yeah. Or you're putting an extra 10% in. And when you're young and people are young and living at home, their cost base is very low. And when it's very low, they can actually save. I've spoken to some people recently and they go, 20%, we can save 60%. And I go,
Why aren't you?
why aren't you?
Yeah.
Or do that.
Yeah.
Please do that. And they do, and they go, we're comfortable saving that amount of money. And that might sound really extreme to some people out there, but what I see is that, when you're 18, 19, 20, first got your job, you're still at home, or you're working part-time and you're going to uni, you can still save, you can still put money away because you won't miss it. And I encourage my kids to do that. I've got them both to read the book, and I think education is the real difference with all of this. So I teach them that's the real starting process. And pay yourself first is really simple. I don't have to record everything else I'm doing, right? I just have to not, like I put 10% away, 15%, 20%, or if you're young and still living at home and board's cheap, 50% of your wage goes away. Spend the rest and enjoy life, because life's not a race to the finish, right? You've got to enjoy it. So, and if you can meet all your other, like your car registration and whatever else you do, you're playing your sport subs.
Let's talk a bit about ways to make money from property. So outside of buying a home to live in, there's many other ways you can make money through property, obviously.
Sure.
In your experience and in your firm, what are some of the ways that you've gone down?
Yeah, it's great. For some of my first home buyers, I actually asked them the question, how handy are you? Are you up for doing a bit of painting or a bit of renovation? And I encourage them to try and buy the worst house in the best street in whatever location they're interested in and add value, or find a house that doesn't have a garage or a carport or a shed. They're relatively cheap items to add value to a property and can create enormous value. I once bought a property in East Doncaster, and it had a classic sort of courtyard in it that had 3 walls of the house to it, so it was kind of internal to the house. It was the cheapest thing to just enclose all that and create another 2 squares and create an open plan in the house. So adding value like that is in my opinion, just to your own home is one of the ways you can do that, and that creates equity straight away. That can lower your loan-to-value ratio and allow you to release that equity to then move into some of the other ways to invest in property, and that is to actually buy an investment property itself, and whether that's residential or commercial. And also, if you're going, I'm not sure I want to expose myself to one sort of property where I'm relying on that one rent, you can also obviously go into, managed investment schemes that that invest into property, and there's a few of those around. You'd probably know more about them than I would, and especially in the retail space, in some of the larger shopping centre ones, that they go pretty good too.
Yeah. So let's look at that second vertical, investing in property just as an investment. So you mentioned a few ways. If I'm somebody who knows absolutely nothing about buying investment properties,
sure,
what are some of the things, firstly, I need to understand in terms of my options? Typically, what sort of capital, risk appetite, et cetera, am I looking at?
Yeah. One of the biggest things one of the things we'd need to know is, do you own a home and have a home loan right now?
Let's say no.
No home loan. So we're just going out to buy an investment property. You're going to need at least 10% of the price, and you need to cover the costs of acquisition. So stamp duty, transfer of land, loan application fees.
Which is another headache. Stamp duty is crazy now.
Stamp duty in Victoria is the highest in Australia.
It's ridiculous.
It used to be that the total costs of acquisition of a residential property in Victoria was about 5.3% of the purchase price. It's now a little over 6% for no reason other than governments are getting a bit greedy. And then on top of that, you've got land tax that you have to pay.
Yep.
And on residential property, you cannot pass the land tax on to the tenant, or if you're selling the property, you can't pass it on to the purchaser. You can't pro rata it for the year
just
either.
have to cop it.
You just have to cop it on the 1st of January every year. So there's some gotchas and that's where I encourage people to look at potentially other locations to invest that are a little friendlier to the investor market. And so the maximum loan size you can get on an investment property is 90%.
Okay.
But you will pay lender's mortgage insurance. And for understanding, there's lender's mortgage insurance. There's insurance the lenders take out for all the loans they do to ensure that money comes back. But if you take a loan out at 80%, at over 80% loan to value ratio, they're going to pass the lender's mortgage insurance premium onto you as a cost. And it's a one-time cost, and it can make sense to a certain level, but it can get quite expensive as well. So I encourage people not to try and go above 88% loan to value ratio and where the lender's mortgage insurance is manageable. But if they can avoid it altogether and have the 20% deposit plus around 6% of costs, so 26%, then they can avoid it completely.
And is it better for me as a first-time buyer of an investment property to invest via, let's say I'm purchasing a residential property as an investment? Is it better to do it on a new build, for example, where I can, let's say get benefits like depreciation or things like that, potentially negatively gear it against the rest of my portfolio if I'm making a capital gain on the rest of it? Or is it better to, sort of look at it differently and maybe a fixer-upper, as you were mentioning?
Yeah, you can certainly buy an investment as a fixer-upper. You're going to spend a few months getting it fixed. You need to, people need to have some good project management skills to be able to do that. I remember we renovated a whole 4-bedroom, 2-bathroom house in 64 days one time and programmed it all in and got it done. And we were actually, it was a property we'd acquired and we were going to flip it and resell it. And we actually had it sold 4 days before we had the renovations completed, which was good. So it was a great outcome for the house. It was a good location. Those opportunities don't come up all the time. People are pretty savvy out there as well as real estate agents. But certainly if buying something, I'm not an accountant and I recommend people get their own accounting advice, but if you buy a new build or something that's under 5 years old, you have the opportunity to actually have available to you the depreciation on the actual build cost for the next 40 years at 2.5% a year. So on a build cost of $350,000, there's about $8,500 you can have depreciation to add to your negative gearing for yourself, which is handy if you've got a large income that you want to offset some of the tax you pay the government. And
which I'm telling you, tax bills, they just keep going on.
Yeah, they do. They do. And we're not going to see drops in stamp duty and land tax too much. I mean, in Victoria and New South Wales, about half their revenue is stamp duty and land tax.
How crazy is that?
Right?
Yeah.
And so because it's so much part of their revenue, we're not going to see too much difference. We're not going to see too much effort for them to change that because they love money, and they want it. So if you are investing, it's good to I think there's sort of 3 markets. There's the new market, there's the renovator, and then you got the middle market. The middle market's good if you're time poor and you just want to set and forget and go ahead and do it. And that happens a lot in regional locations. If you want to get the tax benefits of depreciation on the build cost, then the new market's the space. But then you got to question, where's the capital growth going to come from, because it is a brand new build. But the renovation market, which I've done a few of myself, that's a great space because you can add value and create immediate capital value. And you're getting rent pretty well there as well, and so you can recover the costs of acquisition in your renovation. Like, for example, if you've spent 40 grand on stamp duty and other costs to acquire the property, and you've renovated or had a garage or something, and that property's now worth 50 grand more than it was when you bought it. At least you've covered your costs if you have to exit. So when I did it, I always looked at, if I have to exit today, what position am I going to be in? And it's a great question to ask yourself, because if you buy something new, the chances of you getting your money back after all your costs is limited. And whilst the property is being built, if you bought off the plan and you're not earning any rent, it's not tax deductible to you until you start earning rent. And so you're in this position where you could have bought something off the plan, and if it doesn't have capital growth, and we've seen that recently around the Bellarine Peninsula, where there's been a massive expansion of property south and southeast of Geelong, in that whole area there, which is great, and it is landlocked there by ocean and the port and Port Phillip Bay. And so eventually there'll be no more land to release in those locations, and price can only go up. One would assume. But for the last couple of years, they've been going sideways. So some people who have bought and now deciding, do we want to stay in it, are not really getting out of it at a capital gain.
Yeah. I want to talk about that around that point of mortgage stress, I suppose, because we've obviously in Australia had somewhat of a mortgage cliff come through last year, where you had a number of these loans that were fixed rate, now moving on to variable, suddenly going from 1.5% to 6%, and that's huge difference.
Massive.
And I know a couple of people that have sort of are just working a job, PAYG, and they go, well, shit, now I'm paying $5 or $6 grand extra in mortgage a month. What's that been like? I mean, one, for your business, but in terms of the questions and discussions that you're having with clients and potential clients, what's that been like?
Yeah, we had some clients, and where they were on fixed rate loans at 1.9%.
Yeah.
And then it jumped up to a little over 6%. And they knew they were on a good wicket. And fortunately, they were in a position where they could carry on.
Because they had equity, sizable equity.
Had a bit of equity. Yeah. Well, I mean, the loan, you don't have to refinance. The loan automatically rolls over to principal and interest, and it is principal and interest, but it automatically rolls over to a variable rate. And the variable rates at those times were a little over 6%. Fortunately, they've dropped back, and the competitive variable rates are in the mid to low 5%. Which is great for people. I think there's a little room to still go for them to come down, but they were able to afford it, but they probably foregoing some of the other items. I encourage the people that were on those loans to save as much money as it would cost them if they were on a variable rate loan and paying the 6%. And so they were used to not having the money. Right.
Yeah. So pay yourself
pay yourself, park it in the loan. Guess what? It happens. It reduces your daily interest charge, which reduces your home loan, which saves you money. The other thing is a lot of those loans with the really good interest rates, where they stepped to in terms of variable rate wasn't as competitive as they could be. So provided in my business, there was a lot of refinancing to improve people's interest rates. But the lenders have gotten a bit smarter of late, of the last few years, and they now have more dedicated systems for rate reviews. So we always offer to clients after 2 years to at least do a rate review, if not do it in the first year, but do a rate review and just make sure that the loan's making sense to them and it's still working for them and it's still competitive in the market. And we offer that. And if they agree to do that, the first thing we do is we go to the existing lender and say, can you improve the interest rate?
Yeah.
And we do that first. And the lender offers it, goes, oh, and most of the lenders have pretty good systems these days. Some of them are online, and we just go online and do the request, and 2 days later we get an answer, which is fantastic. So it's a bit more automated than it used to be. And then we compare that to what the market's offering and offer that to the client, and with some commentary around the cost of a refinance is $1,200 to $1,500 and a bunch of time for them. And do we want to, and here's what the competitors are saying, and is there enough savings in a year to cover the cost of the refinance?
Yeah.
And we do a comparison for them and provide some commentary. So that's how we've managed that cycle. We haven't had anybody sell a home because the interest rates went up, which was good.
Okay.
And that kind of also talks to how how lending rules have changed since the GFC as well, because there's a whole lot more scrutiny on loans, and there's buffers put in place by APRA onto the loan. So if you were getting a loan at 2%, you were being assessed at 5%. The trouble with that is within 18 months, the interest rate went up 4%.
Why do you think Australia wasn't impacted by the GFC?
The banking system we have here was, and how finance became a bit of a study point for some of our US colleagues. They wanted to understand how we did it, and I think Australia's been very good at making sure they control how the banks operate, their liquidities, where they get their money from, and the products that are developed. I don't know if you've seen the movie The Big Short. I'm sure you have. I watch it at least once a year.
Yeah, I think so.
And
once every 6 months or so.
Yeah. And there's so much in it. And there's a few Americanisms, which some people would have to, Google to understand and what they're doing. But effectively...
Across many parts. Some parts we won't go into.
Yeah, true. But if you ever want to understand what happened in the GFC, that's the movie.
Yeah.
Right, as to how that happened. And the way it's regulated in Australia, it doesn't allow for those sorts of products to exist that caused the GFC. And plus, culturally in Australia, I think, and government over there decided that everybody should be able to afford a house. And the American culture towards money and finance and ownership is very different. They work on what's my weekly or what's my monthly, and they treat it like they're renting it. But over here, we've been since World War II, and we've been encouraging the government policies was encouraging home ownership.
The culture's different.
The culture's very, very different.
I mean, America is very credit heavy, and Australia's still obsessed with posting a budget surplus, so it's totally different.
Yeah. The GFC only hurt Australia in terms of liquidity and the fear that banks wouldn't, because we don't deposit enough in our banks for what they want to do to lend money out. And during that time, Macquarie Bank actually stepped out of the lending business for a couple of years before they re-entered because they couldn't get any extra money.
But, with the credit stuff, the thing that I fear within the Australian context is private credit's obviously blown up at least 10 times, especially in the last 10 years or so. And I sometimes think whether that creates a race to the bottom in terms of subprime creditors getting, all this money. And if, in fact, let's say, for example, let's play a pessimistic scenario here. Say we enter some form of economic downturn in the next 12 months, which may or may not happen, and might be totally different from GFC, because that was almost systemic. This might be a lot more spread out. But say people end up losing jobs, they go into a credit squeeze, they have liquidity crisis. How exposed do you think private credit is?
As in, when you say private credit, like as in private
so non-banking lenders.
Non-banking lenders?
Yeah.
I look at the likes of La Trobe, and across their book, their LVR is 60% across their entire lending book.
Okay.
So it's they're pretty safe,
Yeah.
and it's a conservative book, and they've been going a long time.
Mm-hmm.
They will be impacted, and I think the issue, but for other lenders, I can't speak too much, but their default rates aren't as high as people necessarily think either.
But they are going up.
Yeah, they are going up, and I think that's a nature of perhaps how their credit policies and who they're lending to, and they're going to, if they're going to be a bit more risky, and they do that, that's the game they're in.
Exactly.
But I don't think, it's a nature. They charge a higher interest rate to cater for some of the losses they may incur. All banks have losses, right?
Yeah, of course.
All banks have losses in
yeah.
the mortgage space.
Yeah, I mean, that's the nature of the business.
Yeah, and you have to cost that in.
Yeah, because, I talk to a lot of people in property, especially in commercial development, and it's always money's tied up in the next project.
Yeah.
And if this project doesn't finish on time, then it's an issue.
Yeah.
Because now I've got an issue of staggering everything in the pipeline.
Yeah.
And that's what happened with COVID, for example, where people couldn't get supplies, they couldn't get labor, and all the projects came crashing down. And a lot of companies folded up.
Yeah, they did. Well, people weren't allowed to, builders weren't allowed to go and do renovations anymore. You weren't allowed to, unless you're an essential business. Dentists weren't allowed to operate.
Yeah. So for people that want to access any of the material that you've put together over the years, including...
They would have to contact me because I haven't put any online, but the material's coming online, and then I'll probably work on that first, and then a book to follow.
Yeah.
So,
all right.
Yeah.
We'll link your details in, so some people,
you.
if they want to contact you, can. Hopefully you don't get too much spam.
It's okay.
But so this show is called On Ramp, and the reason it's called On Ramp is selfishly it's the on ramp to a knowledge highway for myself, and I get to meet amazing people such as you, from all walks of life, and get to have all these conversations. And the thing I always like to ask them towards the end is, what's your next on ramp look like? What's that next chapter that you feel you want to go to? And what's that next on ramp going to be?
It's a great question. I think there's some things out in the world that are much bigger than me. As in, I want to be able to give back more and help more, and working on setting myself up to be able to do that. My next on ramp is, there's probably several facets to it. I'd love my kids to take over the business and succeed the business to them. I'd hate it to just drop off.
How old are they now?
Oh, they're in their mid-20s. My son's finishing uni this week.
Amazing.
Which is
congratulations.
Great. Yeah. He's getting tired. He's had some pretty full-on weeks delivering his final project. He's doing engineering design.
Yeah, I can imagine.
And so he's done a lovely product where he's doing baby car seats for kids with hip dysplasia, and if you're in hip braces, your legs are usually splayed out, and the side bolsters on a car seat at the seat level don't allow the kid to sit in there. So he's designing it so the bolsters can fold out, which is great. My daughter is a model, and she's based out of Melbourne, but has travels to London once a year and does that sort of thing, and loves real estate, likes mortgage broking, has done the Cert 4 course as well. So they've probably got another few years of journey in them before they might consider an alternate career. So that's one on-ramp.
That's amazing.
Yeah, that's one on-ramp. Another on-ramp is to probably develop the education space, not so much for profit for me, but to educate people on this very topic we're talking about today, so they understand and can put themselves in a better place upon retirement, and look after themselves, because I think that's really, the more control people can have over their own destiny, the better off and the healthier they're going to be.
Couldn't agree more. Well, hopefully we're having this next chat when your book's out. So that should give you some impetus to write it, because I'll bug you for the next chat.
You will, and I'll get that going, and we'll get the financial intelligence online, and then we'll work on that as becoming a book.
Oh man, amazing! Thank you so much for doing this.
Thank you, Ali. Thank you for inviting me.